Most investors obsess over returns. The smart money obsesses over drawdowns. Here's why. A 55-year-old with $500,000 who avoids just one major drawdown could retire with $200,000 more. They don't have to time and execute 5 perfect investments. They wouldn't have to make 10 lucky calls. Just one avoided major drawdown. Because here's what nobody tells you about compounding. The math only works if you minimize declines. Surviving a 30% loss versus a 15% loss, that's not twice as hard, it's about 3 years harder. Let me show you the math. When you lose 30%, you need a 43% gain just to get back to break even. Lose 15%, you only need an 18% gain. That difference compounds brutally over time. At a 7% annual return, which is reasonable, recovering from a 30% loss takes more than 5 years. Recovering from a 15% loss, about 2.5 years. Think about that. Twice as much time when time is getting shorter. And that's not compounding time, that's not growing time, that's just recovery time. Getting back to the original amount before the drawdown. For someone who is 60, that difference could mean working until after they are 66 instead of retiring before their 63rd birthday. Same starting point, same disciplines, different drawdown. The takeaway? Smaller losses mean faster recovery, which means more time for actual compounding to work. It's not sexy, but it's mathematical reality. Ed Easterling runs Crestmont Research from a small Oregon town, but his math explains some Wall Street concepts better than most Manhattan analysts. He identified what he calls volatility gremlins, 2 hidden ways that choppy markets destroy wealth. Here's the first gremlin, asymmetry. If you're up 24% one year and down 20% the next, you don't average 2% over the 2 years. You actually lose about 1%. That math isn't intuitive, but it is absolute. The second gremlin is return dispersion. Take 2 portfolios with the same average return, say 8% annually over 20 years. Portfolio A is steady and earns 7% and 9%. Portfolio B swings wildly, up 24%, then down 16, up 24, down 16. Same average return of 8%, but very different ending account values. As you can see, the smooth portfolio ends significantly higher, about 3 times higher. Why? Because volatility is a math tax. Every big swing down erases more than the next swing up can recover. Easterling's insight was elegant. Volatility doesn't make you uncomfortable. It's also mathematically reducing your wealth, even with identical average returns. Now, you might think, I'm in my mid-50s or I'm in my early 60s. Compounding doesn't matter anymore. Not so, Joe. Odds are that you still have 20 to 30 years ahead of you. That's plenty of time for compounding to work its miracle, or plenty of time for volatility to wreck compounding. There's a period financial planners call the retirement red zone, 5 years before and 5 years after retirement. This is when drawdowns do maximum damage because you're shifting from accumulation to distribution. Picture 2 people, both 65, both with $500,000. Same discipline, same contributions. One experiences a 30% drawdown early in retirement. The other has only a 15% drawdown. By age 75, the difference might be $150,000 in their account. By 85, it could be $300,000 or more. Same starting point, vastly different retirement security. And here's the hidden advantage. The investor who limits drawdowns isn't just protecting their wealth, they're preserving their ability to act when opportunities appear. In March 2009, the investor down 15% could much more easily lean in and add capital to the equity portion of their portfolio. The investor who was down 40%, frozen, scared, likely sidelined during one of the best buying opportunities in decades. That's the asymmetry that matters. Smaller drawdowns keep you in the game when it counts. The dollar loss from market declines might not even be the worst part. The behavioral damage could be worse. When fear takes over, many investors sell at the worst possible time. Studies show that large drawdowns cause a lot of investors to abandon their strategy entirely, not just a position or two, the entire plan. A 15% decline, most people can handle that. They stay invested, they stay disciplined. A 35% decline, 45%, that breaks people. They panic, they sell. And here's what research shows. Investors who experience major losses don't just sell near the bottom, they often never come back. They move to cash, they lock in that loss, and then they stay in cash for years, missing much, if not the entire market recovery. Smaller drawdowns protect your behavior and mindset as much as your balance sheet, maybe even more. Let's be honest here, most of us, me included, can't watch our accounts drop 35% and stay calm. And that's perfectly okay, that's normal, it's human. Risk management isn't just about protecting dollars, it's also about protecting the investor behind those dollars. Now, our goal is not to avoid every single decline. The goal is avoiding the big ones that can break your discipline and kill your compounding returns momentum. So how do you actually protect the gifts of compounding? Well, it's not by predicting crashes. We don't try to do that. Instead, we prepare our portfolios for the bigger declines ahead of time. Let's picture two investors back in 2007, both 60 years old, both with $500,000. Both believed in compounding. Here's what separated them when the global financial crisis hit. Investor A kept a 12-month cash reserve, 1 year of living expenses in cash and short-term treasuries. When the market crashed, they didn't panic or they didn't have a need to sell near the bottom. That cash cushion gave them some calm in the storm, but it also gave them some flexibility. It's not exciting, but it's essential insurance for your portfolio. Investor A also diversified. They didn't just own large caps and small caps, which are really more stocks in different wrappers. They owned assets that responded differently to growth, inflation, and interest rates. When one environment struggled, another stabilized. Different engines for different weather conditions. Finally, Investor A used a systematic risk management process, not gut feeling, not reacting to headlines. A disciplined system that monitored conditions and adjusted position sizes when the risk rose. Take the SmartSignal System, for example. The system we built using these principles over the past 20 years when the market declined, SmartSignal tended to decline as well, but generally only about half the amount of the broader market. In some cases, like 2008 and 2007 to 2008, SmartSignal actually stayed profitable while the broader market declined by more than 50%. When you harness the power of systematic risk management, not trying to predict tops or crashes, you respond to early warning signs and limit the potential damage of big drops. Now, I have to say, past performance does not predict future returns. I'll also add that's entirely true. The market evolves and every strategy or system has variability in its returns over time. But let's forget about SmartSignal for a moment. You could use any investing system. What matters most is the discipline you exercise following it. What matters most is having rules that keep you from riding declines all the way down when you don't have decades for your portfolio to recover. Okay, let's get back to Investor A. The result? They retired in 2012 at age 65 with some sense of financial security. Investor B just held on for dear life through the worst of the decline. They were a little shaken for a few years, but they had to keep working until age 69 in 2016. Okay, let's summarize. Compounding is a quiet miracle. It converts discipline into wealth over decades, but it's a little fragile. You have to support it because unsupported, the market will damage it. We can't predict when the next major market drawdown hits. Markets will do what they do on their own schedule. Your predictions, your goals, your desires are completely irrelevant to market moves. We can, however, take a few steps to prepare for likely scenarios. We can monitor the market cycle and pay attention to the warning signs. We can diversify our portfolios across asset classes and across strategies to mitigate market damage. We can also protect our behavior using rule-based systems. Real wealth builders aren't focused on capturing every last percentage in a market rally. They focus on controlling the damage when the markets eventually fall. Protect the curve, and it will protect you. Nothing in this video was meant as investment advice. Nothing was a recommendation to buy or sell any security. It's purely for educational purposes. Past performance does not predict future returns. Here are my full disclaimer statement.